Sorry for that. So guys, let me take a moment to introduce our guest for today. Today we have with us Vidya Bala ma'am. By qualification, she is a chartered accountant, and she began her career as a senior internal auditor for Ashok Leyland. Worked for the Hindu Business Line Research Bureau as a chief research analyst for over 8 years, and she later moved to fintech platform FundsIndia, and she headed mutual fund research for over 7+ years, where the platform pioneered the first robo-advisory in the country, which we'll be knowing from her during our conversation. Overall, she has 20+ years of experience, out of which 17 years was spent analyzing the market. So quite a rich experience, and I am very sure will be benefiting from that experience and try to cover all the aspects of market holistically. And in the year 2020, Vidya ma'am, along with their partners, Srikanth sir, and I forgot the name of other member. I'll ask her.
Bhavana.
Bhavana, okay. Yeah, they co-founded PrimeInvestor.in and yeah, Bhavana Acharya, ma'am. Sorry. So very warm welcome, Vidya, ma'am. Any opening remarks from your end?
Nothing really, Prince. Thanks for having me here, and I'm hoping I'll be able to take on questions and also be of add some value to some of the things that are running in our investors' mind today. So let's get started.
Okay, great, ma'am. So, ma'am, how it all started for you, especially like you started your career as a senior internal auditor and later moved into senior research position. So, how had been your journey of last 20 years, and primarily like the evolution? And because when we talk about market, there are various phases. Initially, when we start, we are in the learning phase. Then as we progress over a period of time, we form a framework through which we do our research and all. So would appreciate if you tell our attendees about that. Yeah, ma'am.
Right, and so my journey is very really inconsequential. It's so there isn't really much to say. Yes, I started off with doing chartered accountancy and audit, but then we were threatened about auditors being either watchdogs or bloodhounds. I don't think I like the idea of being either, so I slowly moved out of audit. So that's about it. And since then, the financial markets has always enticed me. Had started investing quite early on, and the journey is made more interesting by what we see in the markets rather than my own life, right? So over these close to 20 years since I started investing, it is in about the year 2000 2001. So it's been a very very rich experience in terms of seeing the markets evolve and become a far friendlier place today for retail investors than it was 15 18 years ago, when even analysts were struggling to get information, and it was very hard. Corporate governance was not a word that was often used. Things were really hard in terms of understanding the quality of promoters. One had to visit and understand, and it took several years and several mistakes before one could even say that they understood something about a company. This was a time when real estate companies and infrastructure companies were all dime a dozen out there coming out with IPOs. So those were very interesting times, in the mid to 2000s and all that. That has really added rich experience, because we had an opportunity to meet many promoters, some of whom are running huge conglomerates today, and many of them have moved into oblivion. So that's what the market essentially teaches you. The market teaches you that it can move, companies or investors too, from rags to riches, and the other way around too. And I think that's a very humbling message that one receives from the market. So apart from regulatory evolution and all that, I think this is one lesson that we all learn over time in the markets. Back to you, Prince.
So if I broadly ask, like in the last 20 years, what do you think had remained same, and what changes you have seen which has changed the whole what we say sense of the market, how we look at it?
The biggest change I would say is the information available, right? You had to sometimes wait for monthly reports from rating agencies or other databases to even get basic details about the economy or the markets, etc. That has completely changed. Now a retail investor is empowered with information, in fact excess information and sometimes misinformation too. That's the flip side of it. But I think information is still quite empowering, and that's a huge change. And the regulations over the years in terms of investor protection sometimes maybe a little too much too, but that has significantly kind of brought confidence in the mind of investor to come into the capital markets. What hasn't changed? I think that's a very behavioral thing. Uh, what hasn't changed is greed and fear, right? That never changes in the markets, whatever happens, whether it was in the 90s or the Y2K or the 2008 burst, or it's the same. So there is greed, and then there is blood in the market, and then there is fear, right? So this behavioral thing, I don't think will ever change, and it feeds into the market and it helps the market evolve.
Great, great. So, Vidya ma'am, like, what was the thought process behind founding Prime Investor with Srikanth sir and Bhavana ma'am? And tell us more about like how it all started and how it has progressed so far. And I see the concept which you guys have is entirely different and very relevant to the current market situation. Yeah, over to you, ma'am.
Right. So, Prince, you had mentioned that I was earlier with FundsIndia. FundsIndia, is the first, fintech platform for retail online mutual funds. At that time, when it started, it was the first online mutual fund platform, and it fortunately gave us insight into thousands and thousands of investors' needs, the real requirements and financial needs. And one thing that we realized, and at FundsIndia, although we were trying to do our best, we distributors. So we realized that on one hand, how much soever you might try to do the best for the investor, you are still, kind of working for somebody else. You're not working for the investor, because as a distributor or as an agent or as a relationship manager, you essentially work for the manufacturers of the products, whether it's a mutual fund or an insurance, the products that you are selling, right? So naturally, there is a risk, even if there is no bias, there is an element of, or there is a doubt, of seed of bias that can happen at any point in time. And this we have seen being taken advantage of. We have seen many investors being missold products, 80-year-olds being sold ULIPs, missold ULIPs, or somebody who simply cannot afford risks being asked to enter derivatives, and so on, right? So from this was born out of the idea of basically empowering investors and creating a structure that would help, guide, recommend investors, but without the need to be selling the products to them. That way, the the service offering, which is what a prime minister does, would be independent. When I say independent, there would be no commissions, no kickbacks, no ads from any of the product manufacturers. So essentially what we do is, on one hand, we free ourselves from any kind of possible bias that can set in. So we remain independent and we remain directly loyal to the investors, because our business model becomes a simple subscription plan from the investors themselves. So naturally, we work for the investors alone and for nobody else. So this, structure, helped us create something very, very independent that was not there in the market. As you will know, the financial markets in India is basically a kind of a push market, but it's agent driven, age old, whether it's your LIC investors, or later all the distributors of deposits, or your mutual funds, etc. It's a commission based model. So we wanted to create a model that was affordable, very simple, low cost model that would provide quality recommendations to investors in a completely bias free manner. So the investor has no iota of doubt who we are working towards. And 3, since we are not going to do anything for commission, it means we can suggest good quality, low cost products that may not be sold to them otherwise. right? Many agents would not even get commission, for example, from a RBI floating rate bond. Why would nobody earns anything out of it? It's a government product. So why would anybody even tell you such a good product exists, right? So we wanted to change this landscape, make research recommendations accessible for retail investors at a low cost, and in the process also empower them with very powerful tools and guides that they can use, even if they want to either do the research themselves or they want to kind of vet a recommendation that is being given to them by their advisor or somebody else. So that way they remain empowered. These are some of analyzed data that normally nobody gets out there. Unless you're an institution, you don't get access to many of these data. A simple retail investor can probably just get a fact sheet at the end of the month with some point in time data, but not enough analysis, analytical data that will help him make decisions, right? So this is what we are trying to change. Provide unbiased recommendations at low cost and also empower retail investors with tools and calculators that will help them or kind of support or make sure that the advice that they're getting is also good. So that's the idea behind Prime Investor.
That's really great. I must say, like I can also relate it with the porter's value creation as far as business is concerned. So that's really wise on your part, ma'am. So my next question would be like, with so many new products coming in and the complexity in the financial market is increasing day by day. So what is the best way to sail through in such situations, and what would be your advice to investors in need, like who are getting more and more confused with so many products, so they are not aware like which product they should go for, and which products are actually meeting their requirements and maybe their age group and whatever the goal based investment kind of.
Yes, Prince. This is a very good question. So today, just as we have a problem of plenty with information, we have a problem of plenty with financial products, right? So traditionally, we just our parents or our grandparents had to contend with just few fixed deposits from banks and some post office savings scheme, and at best one or two insurance policies. Now you have, you have bonds, you have government securities, you have state development loans, you have ETFs, you have ULIPs, you have PMS, you have AIF. I mean, you name them. And every year there are newer products that are coming. And trust me, these are not just some unregulated products somewhere. Those are dime a dozen coming out every day, right? Even regulated products are so many in number that it's really hard for a retail investor to kind of contend with what is suitable for them and what is not. And unfortunately, this is the real catch. This is being used or rather misused by the selling community to give you unsuitable products. And that's where, the question of why you need to be empowered even comes in. So many of our customers have, bought products that are totally, low on returns. These are, kind of endowment plans and things like that. Or, they have been given products which are not income products at all, being sold as income products, right? They are linked to markets, they have high risk. So this is where sometimes when we go and seek advice, because there is so much complexity, it might actually turn out to be counterproductive, right? So how to really, sail through this is your question. Very simple, rule number one, go only with regulated products, especially if you're doing your own, kind of research or trying to understand. Leave out unregulated products. That's rule number one. Rule number two, look at products, read up on them, or if somebody is explaining a product to you, do you understand that product? Do you understand how a guaranteed income plan from an insurance company works? Do you understand how a ULIP works, or do you understand how an AIF works? If you do not understand a product, please don't go for it. You would remove about 60 to 70% of products right away from your basket if you do that, right? There are other products which you partly understand. For example, you understand mutual funds. You can't say you don't understand mutual funds. You do, but not too much. You understand ETFs, not too much. You understand deposits. You understand bonds partly, not entirely. And that is where doing some amount of research or going to an unbiased source, like, we have our research recommendation platform, or you could go to a fee-based advisor and seeking their advice should come in. The moment you choose to go to somebody who sells the product, you will be confronted with not just too many options, but the possibility of being given a wrong option. So, very simple thing is go stick with regulated products, stick with products that you understand. It doesn't matter. There are always opportunity losses, but there are always opportunities that you will get in the market, such as the Indian market too, because we are a growing market and we are a developing nation. So you should not worry about the opportunity lost in that AIF that, somebody had launched last year, which would invest in emerging companies. It doesn't matter. If their strategy is not clear to you, you don't go for it. That's all. Or if there is a market link debenture, MLD, that's extremely complex for you to understand, leave it out. It doesn't matter. So that's a very simple thumb rule that one can follow to weed out products that you don't really need.
Although it all depends on person to person. So but if you were to take few examples, like a person who is in mid 20s or maybe mid 30s and starting out, and they have I mean, there are certain goals, like their kids education, marrying their kids sometime down the line, and so on and so forth. So with those examples, like which kind of I mean products, or what we say, the financial tools are available, like what would be your suggestion, like how they should go about their investment? I mean, if we were to speak broadly, not specific to any person.
Right. So, for any person, there are just a few things that they need to keep in mind. One, obviously, is the age is directly linked to your risk-taking ability. It's possible that you are young and you still don't want to take risks. That's a call that you can take. But when I say risk-taking ability, it means, can you afford to lose money and still make it up over the years? Yes, you can when you are young. So naturally, the risk-taking ability is something that, one needs to consider based on their age. The second thing is the time frame. So if you have very short time frame for a goal, I mean, you need this money, you need to save this money in 2 years or 3 years, you simply cannot afford to go with high risk products. When I say high risk products, it includes equities or any other, market linked equity product, or very long term products, because those naturally can be very volatile, and they may also cause loss or capital erosion for you in the short term. So that way, go with the low risk products such as deposits, such as short term debt mutual funds, such as very short term bonds, government treasury bills, and so on, if your time frame is very less. If your time frame for your goal is long, then you can afford to add some equities. How do you know how much equities to add? I mean, there are ways to figure. For example, basically at Prime Minister, you can actually go and check for a 3 to 5 year time frame what is the ideal equity allowed. When I say ideal, it means that amount of equity that won't cause a loss to your portfolio over a 3 to 5 year time frame. If, for example, if you just have a 1 year time frame, our tool will say you should not own equities. It would give you zero equities, right? So because there is a risk of loss over a 1 year time frame in equity. So this time frame versus the amount of risk that you can take on, the amount of equity that you can take on, the asset allocation that you can, is a very, very important decision making a point in your investment journey. The moment this asset allocation is right, then you're all set to add products. For example, if you're 25-year-old and you're just saving for your retirement, which is another 40 or 35, 40 years, then you have, and you can take some amount of risk. 60-70% in equity is perfectly okay, right? You can just simply add some index funds to it. You don't need to sit and analyze which is the best fund. You go with the market, choose the Nifty 50, choose a mid-cap index fund, an international fund if you want a flavor. Use some simple corporate bond funds, high quality bond funds for the debt portion, and you're done. That's all that you need to start with, right? And as you go, you can add more variety to this. You can add some value related funds, you can add some growth related funds, or you can simply continue index investing. Sometimes investing is as simple as that, and people make it complex because people, including us, like to believe that we add value for us, right? So we want to make it a little more complex for you, but really investing can also be this simple. So you don't need complex products. When your corpus grows and you feel the need to diversify more, for example, you want to put more in bonds, or you want somebody to manage your money with PMS, that's when the real decision actually starts. So when you're young, you're just starting out with a SIP of 5,000, 10,000. Actually, it's very, very easy, simple, and really you can sit back and enjoy life with a simple index investing or a short your debt mutual fund strategy, and then having some money in PF and so on. That's all that you need. Yes, Prince.
Yes, ma'am. So, we that as today's topic is like the rise of DIY investing in 2023. So, what does really the DIY means, and is DIY not risky?
Right. So a very basic, kind of interpretation of do it yourself can mean that, basically I'm trying to do end to end everything from researching to investing my money and managing, etc. It doesn't have to be. DIY is essentially taking control of your money, taking control of your investments, and not really putting the responsibility entirely on somebody's head. So you want to essentially be in charge. Even if somebody is taking the decision for you, if you know why the decision is being taken and you take responsibility for that decision, I think that is DIY, right? And because you take responsibility for the decision, you automatically try to understand products. You automatically try to do a little bit of reading about them, a little bit of understanding or analyzing them, and so on. And slowly, that's how it starts. And slowly, you understand a lot more. And then you don't just take control, you decide you want to also take the decisions. So that's what DIY is. Yes, DIY is risky, as is, if you think driving a car by yourself is risky, it is risky, but you could have a GPS to guide you so that at least you don't get lost, but the control is still yours. You can still go and crash, right? So that's, but remember, if you had a driver, even that person could have gone and crashed your car. So it's the direction, whether you are being taken in the right direction, whether you are being led in the right direction, or you're using the right tools and channels for being led in the right direction, even as you ride the car yourself. To me, that's DIY investing.
Right. So we have one speaker in between. We take one question from him. Ravi, you can ask your question quickly.
Yeah. Uh, Question. So now, like everyone talks about that as an individual, one should invest in the direct plan. But when we go with any certified or any of the one who could guide how to invest in mutual fund, then they usually ask us to invest via their portfolios or via their channel where they invest in the regular fund. So in that scenario, how should an investor really go when he has a 15-20 years of time frame? Should he really go for the direct one, or he should engage one who can guide us, and it is all good to invest via regular where he is generating some more 1 or 2% than what a person is doing via DIY.
Right. See, if you are an investor who's investing for the long term, it makes immense sense to do the direct plan. And it is probably miscommunicated to you that you will not get guidance if you go do the direct plan. Actually, the registered investment advisors, or RIA as they are called under SEBI, are people who are supposed to guide you for a fee. So they are called fee-based, financial advisors. They take a fee from you and they recommend investments, and they can also help you, execute, but through the direct plan, not through the regular plan. So that way, you are getting into lower cost. You are going to save for the long term. For example, if you take, the flexi cap category in mutual funds, there is as much as 1.2% difference between the average expense ratio of direct and regular. So imagine the amount of savings that over the long term, and especially if your corpus grows large, it will be significantly higher compared with the fee that you might have to end up paying a financial advisors. So you definitely, long term investing, direct plan is good. If paying a fee doesn't appeal to you, because many of us don't, as Indians, we don't want to pay for services that are invisible, right? They're not very tangible services. You could go for a distributor, but you could also use channels like ours to see if you're being given right products. You're not being given excessively high cost products. For example, we have something called the expense ratio tool. You can actually go and check where the expense ratio of your own fund stands as opposed to other funds out there. Are you being sold a higher expense ratio product? If you're being sold a higher expense ratio product, it means that there is a higher commission component that is going to your distributor. If you're asked to change a fund from X fund to Y fund, is the Y fund actually being given because the X fund was not performing well, or is it the Y fund having a higher expense ratio? Now, these are the questions, that one needs to be aware of if they go through a distributor. But I think, there is a healthy RIA community today, and you could go for a fee-based advisor if you have a large corpus, or you could use services like ours where you just pay a very flat fee, which you recover in, less than a year in terms of the expense ratio that you save. These are options available to you. I would strongly recommend that you give a direct plan a kind of a rethink and see if you can get a good advisor with a direct plan, or use services like ours if you're willing to put in a little bit of effort in terms of execution. In the long term, I think the route will be about direct plans.
Ravi, I hope this answers your question. Any follow-up or?
Yeah, thank you so much. I don't know whether I am permissible to ask one more question, if it is possible, or we have some time. Hello? Shall I ask?
Yeah, please.
Yeah.
Please ask.
Sorry. Okay, thanks. Okay, and now with respect to a large SIP amount, or when you talk about roughly like 2 or 2.5 lakhs rupees, is it advisable to have an index fund, or that is for question number one? And secondly, ideally, how many funds we should diversify, or I mean, sorry, I mean to say total number of funds for a large SIP of more than 2 lakhs rupees. If you can guide us.
Vidya ma'am, you are still on mute, so please unmute and answer them.
Sorry about that. So you asked me about the number of funds. We actually have written an article on number of funds that you should hold. You can just go Google on our site and you'll get it for free. But to answer your question, when you have larger sums, it does make sense to just, even if not anything else, for your own mental comfort, to just have slightly more number of funds. We say as your corpus grows, say, and you have SIPs of 2.5 lakhs or 2.5 lakhs running, you could afford to have overall in your portfolio up to 8 funds, and you could be running SIPs on not all the 8 funds at a time. You could possibly be running SIPs on 4 or 5 funds at a time, and then you could add some more over a period of time, etc. So the portfolio size per se could be 8 funds, 10 funds, or even up to 12 funds. There's no harm, provided you are able to diversify the strategies. For example, if you take our list of prime funds, we very clearly say X fund is value oriented, X fund has a growth tilt, this debt fund takes some amount of credit risk, this debt fund invests only in corporate bonds, this fund has a low duration, it will fit your low time frame. So if you mix these, then what happens is your portfolio becomes strategy diversified. So even when one strategy is not doing well, for example, when value is not doing well, growth does well, or like now when value is doing well and growth does not do well, you'll still have some returns in your portfolio. Similarly, when in a rate falling scenario, your longer duration funds will do better. In a rate rise scenario, your shorter duration funds will do better. So mixing these, or if you even see the nature of our portfolios, that's how we mix. So more than the number of funds, it's actually the mixing of strategies that matter more. If you're confident, if you're not worried, that is, and if you're doing index investing like you suggested, even having just 4 funds with index investing, it's perfectly fine, provided you have diversified them. You have one say Nifty 50, and then you have a mid cap 150, or you have one 500. You mix them. So you either do that, or if you're going with active funds, you make sure one has a value tilt, one has a growth tilt, and so on. So these most people will not tell you. They will still simply tell you, we'll give you 2 flexi cap funds, we'll give you 3 large cap funds. That's a very flawed way of approaching portfolio building. Please remember that if anybody is giving you, you should know that they're not good advisors, right? They should make strategies for you. That's what we try to do in our own ready to go portfolios, or even in prime funds. If you want to choose your own prime funds or you want to use our tool, we make strategies. We don't focus on number of funds. We focus on ensuring that you get different strategies. But please read the article. Like I said, it actually states the number of funds you can hold for different portfolio values, etc. Just for you, that's not a rule, but it gives you a ballpark figure.
Thank you so much.
Thank you, Ravi, for your questions. And with them, I can, reckon like obviously people are what we when it comes to paying upfront fees, people are reluctant, but they often act on others' borrowed conviction and tips and tricks in Telegram groups, and they end up losing much more money compared to the holistic fees which one advisor is charging, which is a reasonable one. So with them, like when it comes to money, initially, like there is when we start, the initial corpus, as you rightly said previously, is small. Over a time, it builds. But at that point in time, people are clueless how they go about investing this. On the top of that, like the amount of fees in comparison of the investable amount for that person is also one thing which I would like to ask you, like how one should go about, and what should be the, in maybe in percentage terms, a reasonable fees one which one can pay to the advisor or maybe fund manager, etc., etc.
Right. So I just want to, share some of the interesting portfolios that I have seen of people who have invested for 15, 20 years. I have seen 100 funds, 150 funds in a portfolio. And trust me, that portfolio would not have moved much. The reason is that the good performing funds are pulled down by the bad performing ones. So over time, you just build a motley group of basically every out and every NFO out there would have been sold to you, and every fund that is the topper this year would have been sold to you. So you end up with 100, 150 funds, and it just becomes next to impossible for you to identify how to keep them, which ones to remove, and so on. That's when you start needing help. Of course, if some of you had already used our mutual fund review tool with our buy, hold, sell recommendations, you would have already probably removed many of the funds that you held this way. But if not, if your corpus is very large, it's too cumbersome for you to do this yourself, that's really when you need to seek advice, especially fee based. Please remember, if you again go to another distributor, you're just going to be churned and end up with the same number of funds and probably just given a new set of funds. So just go to a fee-based distributor and see, the model today in India works very differently. See, if you're going to do this yourself, you could finish this for as low as 3,000 and 6,000 for our products, which is what the price is. But there are fee-based advisors with flat fee of 25,000, 30,000, 50,000, and so on. And there are people who charge 0.25, 0.3, 0.5. It varies a lot. The calculation that you need to make is how much do you, especially if your portfolio is mutual fund tilted, how much do you save in terms of the cost. You can use, like I said, our expense ratio tool to understand in each category roughly how much you save by going direct. If this differential, if your fee that you pay to your advisor is within this differential, you are actually saving money. For example, like I said, the flexi cap funds on an average had a 1.2 percentage point difference, right? And the fee you're paying is probably 0.5%. Then you're actually still saving. So it's worth it for you. So that's the analysis that you can kind of make, and you can still hold tools like ours to check if what you're because we do the research. We're not in the business of basically just doing review and financial planning. We are in the business of research, so you could still check if the funds that are being removed or the funds that are being added are are good funds based on our research too. The other thing that you need to keep in mind is fee vary for various products. PMS has a very different fee structure. AF has a very different fee structure. So there, the important thing is for you to kind of understand. Don't compare that with mutual fund and think it's high. That would do that, because there is a lot more management that is being done there. The way you should look at it first is that whether you need to go for such products or you can simply manage with mutual funds. If you are going for such products, is the strategy of that particular PMS or AF going to deliver very high returns that the fee is worthwhile, right? So that's something that you need to ask them in terms of showing their track record, understanding what other funds they had managed and so on. So the fee varies very widely, to answer your question, Prince. With mutual funds, it's a lot more easier. I told you this thumb rule where you can look at the differential you save in direct plans and whether your fee is within that. That's a very simple thing to do. Or you could be a DIY with tools like ours. Or if you go to other products, do so with some amount of, if you're in a business and you are getting quotations from various people, when you go to PMS or an AF, you need to look at least, half a dozen products before you freeze on one. So that's important. That's a lot of effort too. So please, if you don't have the time, avoid products where, you will need to pay some higher fee and you don't really know how it's going to be managed.
All right. So when it comes to different products, right? So basically, like how to make the segregation. A few pointers you already made, like the regulated products, and you understand the products, which is fine. But when it comes to churning, right? So like buy and hold doesn't work for us, changing very fast. So accordingly, we have to move. So we have both the sides to it. Like how you view it, like churning the portfolio in the sense.
Okay. Segregation, yes, we spoke about it. Staying away from unregulated products is one way to just, remove unwanted stuff. And within regulated products, like I said, things that you understand. And within that, products that fit your time frame, right? So once you have goals, you map the time frame of your goals to products that suit that time frame. You can't possibly hold a 10-year gilt and for a 1-year period and hope that you won't get negative returns. 1-year gilts, 10-year gilts can give negative returns even 1-year period sometimes. So so time frame based approach will help you further choose products that will fit only your time frame. If you're a longer investor, obviously equities, longer term investor, equities will form a part. The shorter term, you can keep your products to mutual funds, ETFs. When I say mutual funds, you can even stick to just active mutual funds, or ETFs, which are also, stick to passive mutual funds and add some active funds. You can stick to ETFs, you can have debt funds, or you can simply go with simple deposits. Today, small finance banks, some of the larger ones offer attractive rates, and up to 5 lakh is, backed by insurance. So you don't even have to worry much. So very, very simple products. You can actually go and read more on our varsity on the kind of products that we have, and, pick what you think will kind of choose you. The other question that you asked, Prince, on this, sorry.
Yeah, so basically,
Prince, you had,
yeah, I ask about the portfolio churn, like what's your view on
yeah.
that?
Yeah. So it depends on what sort of investment products that you hold, right? If you are holding more debt, there is very limited need for churning portfolio, provided you have done proper mapping of your time frame to the debt product. If you hold equities and you're doing passive investing, that is, you're investing in index funds and ETFs, there's very little need to churn your portfolio. Because by going passive, you've decided you will just hug the market. You will stick with the market. So whatever the market does, you do. So there is no beating the market when you go passive, right? So what's the need to churn your portfolio? All you can do is just do an annual review. If your equity of 60-40 has moved to say 70-30, that means your equity is inflated. You can do an exercise which is called as rebalancing, which is bringing back the equity from 70-30 to 60-40, right? That's a rebalancing exercise. That's about it. Passive investing, no problem. Active investing, yes, today the ability of funds to provide sustained performance for too long is coming down. And that is one of the reasons, why we keep saying, in some categories, passive makes more sense. At Prime Investor, we have reduced the number of large cap active funds that we give. We specifically add passive funds in the large cap category, whereas we still give active funds in small cap, we still give active funds in some mid cap and so on. So we look at categories, we realize some categories you're better off being passive. In those cases, you don't have to worry. In the active places, you have to periodically, say on a half yearly basis or at least an annual basis, see if your fund is underperforming by, say, 5 percentage points or more than the index or the peers, in which case you do have to take a relook. I mean, you can either go and search for more information, or you can use our tool, etc., to see what our recommendation is on that particular fund. But fact remains that if you invest in active funds, review, I'm not saying review will automatically lead to churn, but reviewing periodically is very, very important. If you want to reduce that, I think it's very simple to just stick to passive funds. Many investors now, because of all the controversy of Adani stocks being in index, etc., many investors question passive investing. I don't think that argument really holds water. Passive investing is what it is. Whether there are good stocks, there are bad stocks, but that's what the market has put on the radar. It is market cap based investing, right? There is no fundamentals involved in passive investing. What the market believes are good stocks are given more weights. What the market believes are bad stocks are given low weights. So the market basically, it's a self-correcting mechanism that the market does with passive investments. And we do think if you're a DIY investor, some part of your core portfolio should definitely be in passive. That way you can also avoid churn and avoid excessive review that would be necessary otherwise.
Great, thanks. So we have another speaker, Srikanth. You can quickly unmute and ask your question.
Am I audible?
Yes.
Yeah.
Yeah. So my question is, what is a realistic? I know we must not expect any percentage of returns from passive investing, but I'm just asking you from experience. What is the realistic, rate of return that we can expect in the longer run, not in the shorter run, say for a 10 or 20 years period? Because we hear a lot of big numbers like Sensex will reach to 2 lakh, 3 lakhs, and all those kind of numbers. So I'm just asking you a realistic, rate of return so that we can prepare our mind that this is what we can expect from index investing or passive investing. Thank you so much.
Okay. So whether it's active or passive investing, sir, I think it's good to be prepared. Even in fact, it's good to be prepared in active investing than passive investing, because active investing can disappoint you. Passive investing will never disappoint you. A simple reason being, it is just as good as the market. That's all, right? So whichever way, setting a realistic return expectation is a very, very important part of your DIY investing. So most of us consider these as Excel numbers. We put 15% returns on a fund and reduce the monthly SIP that is needed to achieve your goal. So it's just math, right? So you increase the returns, you can reduce the monthly savings. If you reduce the returns, your monthly savings goes up, right? So we like to believe that we can save less, but reach the goal with higher returns. But this higher returns is not in your control. The only thing that you are in control of is your saving. So the best you can do is keep your savings rate, your investment rate very high. So that's one thing first. On the return expectation part, honestly, returns in the markets in the long run, as I have seen in these 15-20 years, are slave to only one thing, which is earnings, right? Earnings of companies. If you're looking at Nifty 50 returns, Nifty 50 returns is a slave to the earnings of the companies that are there in the index. So it is entirely boils down to fundamentals in the long run. All the indicators that give you the outlook of, we'll do look at charts, look at technicals, where will the market, but all those, can change overnight with one external event, like the Russia-Ukraine thing entirely changed. Commodities had a big rally everywhere. Everybody thought commodities had cooled off. And then this war comes, and then again, you have this inflation going up, and then you have commodities, all of these. So everything can go completely haywire. As far as we are concerned, India being a developing nation, which means it has a healthy inflation and its ability to grow is also higher. In general, the nominal rate of growth in the economy is the realistic return that one can expect. Nominal is inclusive of inflation. Otherwise, it's the real return plus the inflation. So if you look at 5-6% inflation, and the RBI doesn't expect inflation to fall next year and so on, you have to add that to the GDP that is estimated globally. All these big banks and the RBI estimate what sort of GDP growth happens. Just to give an example, if 6 to 7% of GDP is expected and inflation is expected at 5%, then 11% is the estimate that you have to have in your mind. Only in periods of very high inflation and very high growth, all this 15% estimate should even be made, right? And India, remember, post 2010, it has not gone anywhere in terms of GDP of 8% or 9% and so on, in terms real terms. So our although this 15% returns, etc., come and go, in the long term, it makes a lot more sense for you to keep your return expectations very, very realistic. If you take the Sensex 10-year returns in a boom, post 2010 period, in the last 10 years, the Sensex is given around 12% returns. That's about it. The Sensex or the Nifty at 11.5, 12%. That's about the returns. And it's not like mid caps have delivered high. Mid caps had about 14% returns. I'm talking of the index here, right? It's not, and not like funds are way away from this. They are either at par or they are lower than this. Even the BSE 500, which is representative of the entire market cap, 10-year returns, about 12%. That's all, right? So, and we are talking of a period when, we could have done better. And, but unfortunately, there wasn't much capex being added. The earnings, remember, of Nifty 50 was very weak in these 10 years. The US markets, the S&P 500 and NASDAQ did a lot better than the Indian companies in terms of earnings, and that is the reason why the last 10 years was a glorious decade for the US and not for India. Things could well reverse, but just saying. So please bear that in mind. So the GDP expectation, the real GDP plus the inflation expectation, is the only thing that you have as a real tool to build these scenarios. Anything else, in my limited experience, are just numbers to kind of just add fluff.
So, Vidya ma'am, is it fair to assume, like, if we have the process right and we keep our goals ready, like we are clear about our goals and the process is in place, so the whatever follows is like good returns, leaving aside any exact number, right?
Yes, a very simple, clear process, discipline in investing, and a high investment rate. These are the things, and a balanced approach to your investing. These are the things with asset allocation. When I say balanced approach, have some equity, have some debt, and if you like gold, have some gold. That's the only way. There are no other magic formulas. And with all that, after 10 years, if there is a huge meltdown like 2008, you will still lose some amount of money, not your entire capital, but your maybe a portfolio that was delivering 15-16% would have fallen to compounded return of 11%. But that's the way markets work. So the best you can do is save more when you have money, right? That's the only way you can absorb these shocks. These shocks are inevitable and they can happen anytime. So you simply have to save more, and you have to put them out where you need money as you retire. You have to put them in safer instruments. You don't have a choice. You can't afford to allow your equity to grow till tomorrow, till when you are going to withdraw the money. One market correction can reduce it. So as you reach your goal faster or your corpus really swells, move them to safer options, whether it's FDs or short-term debt mutual funds, or if you want to generate income, use the floating rate bonds, use treasury bills, these days, please remember, all treasury bills or government securities are available through the RBI retail direct platform for free. You don't pay any commission, you don't pay any distribution. It's just that nobody recommends this to you. Why? Because nobody gets commission out of this. These are the kind of products why I say that you need to empower yourselves. DIY can be very enriching. You will discover products that are lesser known to you if you are just able to put that little bit of effort to read up or to kind of know what these products are about.
Yeah, Srikanth.
Yeah, thank you so much. Just a follow-up question I have. So I think the Nifty Next 50 I think over the last 4 5 years, it's given very minimum return. I think it's 4 or 5%. Correct me if I'm wrong. The reason why I'm asking is, suppose prior to that 4 5 period, if you see the returns, it was showing around more than 15 or 20%. So we as human beings, we have a psychology like, yeah, it's giving me 15%. Go ahead and just invest in those funds so that it will continue giving me returns. I know we should not expect, but it comes very naturally. Okay, this is giving good. This index is giving good. My question is, what is the trigger point now? If you see the last 5 years, it's even very minimum returns. Now what is the trigger point that I have to shift from this index to the other index? Any a guideline or something like that?
Okay. So one thing that you're right, there's nothing that you can do because the Nifty Next 50 has shown years of significantly high performance and years of very bad performance. Last few years, it has structurally changed. By the way, if you can register for free with us next week, we are actually writing about how the composition of the Next 50 has changed. I'm just giving you a kind of prelude, entirely tracking its history and how it has changed over time and why it has become what it has become today, right? Like my colleague used a very special word in that, in terms of whether it's really putting the emerging companies or whether it's being used like a recycled bin. But that's interesting. We'll keep that aside. But what you can do is restrict your exposure. See, the Nifty 50, for example, is a primary bellwether index, right? So you can afford a 20% exposure, 30% exposure, and so on. But in all other indices, like the mid cap 150 or the 500 or the next 50, what you can do is limit your exposure. That way, at least the impact is not very high. See, we talk of the next 50 having fallen so much. It has exposure to, double-digit exposure to Adani stocks and all that. But what is that impact on your portfolio? If you had just held, say, 5%, 15%, not really high. 2-3% hit, maximum 4% hit, it doesn't matter. Right? It just seems high when we look at it individually. But the fact is, when you're holding it as a portfolio, any portfolio will take hits in some form or other. And it so happens to be next 50 this time, right? So having taken the decision, don't worry too much about it, right? The only thing that I would say is, one, limiting your exposure. Whenever you are moving out of bellwether indices and doing other investments, the key is to diversify, right? If you do that, actually the hit won't be too high. The second thing is, you could use metrics such as if you're holding, for example, next 50 index fund, you could use metrics such as the average rolling returns. Rolling return is a far better indicator than point to point returns. It will tell you when an index starts steadily underperforming, etc. So you could look at those, and you could look at the Nifty 50 funds also and see a kind of gauge how much the underperformance is. See, after all, next 50 is an aggressive in a fund. But if it's 3-year and 5-year, rolling returns are struggling to beat the Nifty 50 now, which is a large cap index, something is really wrong, right? If it's steadily the case, then you have to kind of fake up. But it's not easy, right? It's not easy taking this second route because it involves looking at numbers very closely. It also involves looking at portfolio. Sometimes all this cleanup is made and suddenly next 50 will look good and it will do exceedingly well because the very poor companies will get out of next 50, right? Sometimes. So what happened last time? I mean, the new age IPOs came into next 50 and they really pulled down the next 50. And now the Adani stocks pulled down the next 50. So it became double whammy. But if they get cleaned out soon because they lose market cap, then it self-corrects, right? So I won't say you should worry too much, but if your exposure is very high, the best you can do when you don't know how to identify indices is to reduce exposure. Second thing, stick to market cap based indices. You have now a lot of multi-factor indices, you have value, you have momentum, and then you have alpha low wall, you have alpha low wall, lots of them are there. Even we have tried one or two. And I admit that we had to kind of give calls to exit some of these funds because those back-tested data just remain data. These factors don't work across markets. Just like value does not work across markets, nor growth works across markets, multi-factor indices does not work across markets. So the best you can do is reduce its exposure, or not go for those and stick to mainstream indices. So that would be my primary advice to you. The second thing is to kind of see when the underperform starts, how long is it continuing, as the proportion of underperformance very high for it to, regain its past glory. All these things are more research work. You could, take those cues from us. But primary thing is to keep your, exposure limited in any aggressive index.
Right. So just wanted to check with them. I'm like, I have a couple of questions left. So we are good on time, right?
Yeah, I'm good.
Yeah, so a very one thing which most of us struggle a lot is like how do we start doing our own research, and specifically when it comes to like researching mutual funds or the passive investing way, it is further difficult for. So would like to know on both the aspects, be it direct equity and mutual funds.
Okay. So I'm going to give a very simple solution. Okay. You could use to know what metrics you need to use to do your own mutual fund research. Just go register for free with us and check our mutual fund screener. We have something called under tools and calculators mutual fund screener. If you register for free, you'll be able to use it at least, over the trial period. You can use it to understand what are the metrics. We have put the very relevant metrics there, whether it's in terms of proportion of outperformance or using rolling returns, the average rolling returns, the downside, the standard deviation, the Sharpe, all that. You will have all the performance metrics. The second key thing is the portfolio metrics. What proportion is there in, is a fund really too high risk? For example, a multi-cap fund or a flexi-cap fund can have, some of them can have very high exposure to small cap, some of them may not have. So you need to understand that risk. So you look at portfolio, you look at, the weights, you look at the percentage of mid cap, small cap, all of this will be available to you. Similarly, you can look at the expense ratio. You can look at how quickly the fund churns its portfolio. A very high portfolio turnover fund basically means you're just taking tactical calls. You will see this in quant funds, just to give you an example. They keep churning their portfolio. They take very tactical calls, very momentum based calls. So you will see high portfolio. Then there is no real long-term strategy. It's more short-term strategy. What is the kind of cash that a fund holds, right? Having cash for very long without deploying can hurt performance. Quantum mutual fund, which was once upon a time a very glorious fund, was hurt because it held cash for very long. So these are things that you learn when you start looking at data. You don't have to know it right away, but then you could correlate it with our own recommendations. You can check those funds on the MF screener and see how we do it. Now, once you get an idea of all these metrics, could go ahead and use this screener to churn out data and try and understand, or you could build your own framework with it. But since this is available and you are free to use it, please try it. Because each of these metrics will take at least 15 minutes for me to explain. So it's easier if you go there and we actually explain how to use also, so that, you kind of don't get lost in terms of doing it. All that is too difficult, you can always just, look for recommendations and go with them, or simple index-based investing.
Right. So although like some points we have already touched upon this, so when you think an advisor is needed and how to figure out what kind of advisor is suitable to one's need.
Yeah. See, you really need an advisor when your corpus gets to a point where you think you don't have the time to manage it, right? That's really a time you need an advisor. And you could, when your corpus is really large, I would suggest you go with a fee-based advisor. When you're somewhere in the middle, neither here nor there, you could go for a distributor. But like I said, then you need a tool like ours to cross-verify whether the distributor is giving you a low-cost product. Is he or she giving you a product that is consistent and not just a chart outperformer, and so on. So try to do a little bit of your own research if you're going with a distributor. If you have, say, like 20, 30 lakhs or 40 lakhs of corpus and you still prefer a distributor, you don't want to pay a fee. If the corpus starts running into crores and you don't have the time to even review them, look at them once a quarter, forget review, even look at them once a quarter to see what they're doing. It's time that you paid a fee to get a good advisor.
Right, ma'am. So when it comes to your own personal investment, so what approach you take and how diversified are you across the asset classes, ma'am?
Okay, so I for long I have always kind of been a very high equity investor, but over possibly with age, you're kind of, it's not like your risk mellows down, it's just your time is snatched away from you. So debt started forming a slightly higher portion of my portfolio, so about 60-65% in equity, and maybe under 3-4% in gold, and the rest in debt is what I have. When I say gold, I mean I don't hold any physical gold, I just hold the gold bees and a gold fund. So in terms of risk, I prefer to take risks in stocks. I keep my mutual fund portfolio kind of a stable and core one. So that is always there for me, and I allow it to grow. With stocks, I do take not a very short term approach, but a little bit of an active approach where I kind of book profits if I see my stocks have swelled, and I don't look back to see if the stock has grown more, and many of them do, but it doesn't matter. So that's the way I manage. My right now my mutual fund portfolio would be larger than my stock portfolio, although I started out with a larger corpus in stocks because I didn't have the time to kind of diligently manage. It became more of mutual funds.
Right. So if you would like to touch upon like what is the thought process or framework you follow, be it from the idea generation to studying more and finally ending up investing in a company, if I were to ask for direct equity investments?
So for me, mostly it's mostly a bottom up approach where I like what a company is doing, and I think it is hard for too many companies to replicate it. In other words, when I see company with a high moat, I really get attracted and I try and kind of understand what is it that is giving it this moat. And then of course you get into numbers, you get into business prospects, and then you get into the company governance issues. Then there are companies where that these companies are basically bread and butter. You need to have them. Many of the large blue chip stocks from IT or from banking, I have held them for I don't know how long, uh, a decade and a half or so. Now those became my core part of my portfolio, and over the years I have added, and those remain the ones that have really built my wealth. Right, these are companies that will probably deliver 12 to 15% compounded annually over the long time, or did deliver. They may not deliver in future. I have also periodically booked profits in them, but I have also added them and so on. So there's no harm in doing that, right? When you think something has peaked, but you still like the company, but the valuations are expensive, you kind of just remove some profits. So my approach basically has been to have some bread and butter companies that will be as part of my core portfolio. I don't have to think or worry about them. They just lie there. They're mostly blue chips. They are always blue chips. Some of them may have entered as mid caps and became blue chips. They will lie there. And the ones which have differentiated business, which show earnings growth prospects, and the moat will remain for a while. I do get interested in those companies, and I try to understand a bit more about them. And I must say that some of my bets have really bombed, and I have tried to take risks, and they didn't work out. I mean, there are companies where sometimes distress sale and takeovers happen, and you bet on them, and they work, and in other cases, it just goes down the drain. But that's part of investing, and I make sure those are not high proportions. When I take those risks, they are small bets, and I have lost a lot of money, and that's fine. I have learned, so that's fine.
That's great, great. So we have another speaker, Tanmay. Tanmay, you can quickly unmute and ask your question.
Hey, thanks, Prince. And Vidya, I think interesting talk. I just joined in about 15, 20 minutes back.
Hi,
Uh,
hi.
I hope, Hi. So, quick question. Let's say on your equity portfolio, your own personal equity portfolio, what kind of approximate return you would have made in let's say a Jan December 2022. One second question is that many of the good stocks, fundamentally good stocks, have dropped like maybe 30, 40, 50% from their peaks. And how do you approach such stocks in the current scenario and environment, which is extremely uncertain? And I think at least for the next 1 year, the way I see it with the US elections and the Ukraine war, and of course the Indian elections also coming up. So a lot of uncertainty in the air. How do you see some of these stocks which have dropped by 40, 50%?
Yeah.
And
So,
decent stocks. Yeah.
sure. So the first question on my returns, I really, in 2022, see, when you build portfolio over 15, 20 years, I don't think, at least for me, unless, you're an exceptional investor, it's very hard to probably beat the index. So, although my 2022 investments were really good ones and they yielded well, because I had invested in some auto and in some capital goods companies, and those delivered very well. They are still, remember, a very small proportion of my portfolio that has grown over 15, 20 years. So of the other stocks, they would possibly have just about kept pace with Nifty. I had removed some of the duds thankfully in 2021. So I had fewer of the duds, but I don't think my entire portfolio would have done anything exceptional in terms of, beating the Nifty. What I can say is my investments in 2022, of course, delivered well, but there's still a smaller proportion of the overall portfolio. So the investments in 2022 very easily would have beaten the Nifty 50 by about 10 percentage points. And thanks to my analysts, those are some of the stocks that we recommended and then took stakes in. Obviously, we have our disclosures out there, and some of them are our own small case portfolios, like the auto small case portfolio that delivered very well for me. So those are some of the portfolios that did well for me. On the question of stocks, that's a very relevant question. And we are in an extremely tricky situation today where some of the stocks have fallen so badly, and they look like their value, but you can never be sure whether they are value or value traps, right? Because these were taken to valuation heights that were never seen before. Just to give you an example, during COVID, some of the post-COVID or immediately, post-COVID, the pharma stocks, the chemical stocks, the hospital and lab, chains, all of these valuations were so expensive. Have all been beaten. They have been beaten and brought down, and not for no reason. Their earnings have also taken a beating because that COVID effect, the charm had kind of, fallen. So one or two among these could be gems. The only way to identify is if they are showing earnings momentum, if they are showing earnings traction. Please don't pick any stock which has fallen 40-50% with too many dark horse theories built on them. They can bomb because we are in a very transitional phase in the market right now, right? There are too many things happening, whether it is in terms of interest rates, whether it's in terms of economic growth or the capex boom that's happening, or whether it's in terms of election year coming up, whether it's in terms of the US, the federal rate changes and recession. Because there are so many things, the only thing that you can bet on is earnings. If a company's earnings is showing traction and it is still, fallen sharply or not climbed much, you could pick them. And please remember, the market is always smarter than us. The market identifies those stocks quite early on. So even if we enter halfway, we are okay. So we don't have to necessarily enter the 40-50% falls. Even if a stock is say 15-20% of its highs and the earnings have shown traction or a balance sheet cleanup has happened, you can see that in many of the steel companies, right? Not only are they adding capacities, many of them have cleaned their balance sheets. Take NBFCs, banks. Why did banks and NBFCs do very well towards the later part of last year? They had completely cleaned their balance sheets. They were showing clear credit growth. So those are the signs, and the market picks them. and you simply ride with them, right? CapEx. After almost 10 years, capital goods companies are adding capacities or increasing their, production capacities with existing, without adding new capacities. All this is adding to earnings traction. So you look for earnings traction, period. That's what we try to do. That's what my analyst at Prime Minister, we all try to do. And we get it right sometimes. Yes, Prince.
Right. So Vidya ma'am, like 20 years is a long time. You must have made so many mistakes. So would appreciate like if you would like to touch upon few mistakes so that we, those who are attending today, can relate and perhaps don't make the same mistakes and benefit from that.
Right. See, my so there are mistakes as an analyst and there are mistakes as an investor. I'll share them both. Mistakes as an analyst, you get so enamored with sectors that are booming that the risks are completely downplayed. And I have done that with real estate companies and infrastructure companies that I was covering, in mid 2000s, and by 2008-10, half of their story was finished, was done with. Half of the stocks I probably covered. Some of them just took deep hits. Some of them became from large cap stocks, they became small or mid cap stocks. There was significant market cap erosion, and one or two went into oblivion totally. So that was because I was simply not geared to understand, one, the risks of a business, the inherent risks in business such as infrastructure, real estate. It's not just debt, please remember. It is the maze of group company transactions. We are talking so much about Adani and the group companies and holding all of those. This has been there for 20 years now. This sector is such that it has a maze of transactions, a maze of kind of group and holding companies, that even risk in one or two, your call can go entirely wrong. So that's something that I learned as an analyst. As an investor, two things. One, your winners don't matter if you don't have the size. There's no point having said, I picked a super multi-bagger. I had invested 10,000 and it has, grown 7-8 times. It doesn't matter. 70-80,000 in a large portfolio adds nothing really. Of course, if our corpus is small, it does, but size matters. So when you're taking positions in stocks that you believe in, you need to build positions, right? I learned that very late, and now I know I have many of the blue chip stocks that have really kind of, are the pillars for my portfolio, but I learned that really late. You cannot be taking 1,000, 2,000, 5,000, 10,000 if you decide to build wealth. That's not how it happens in stocks, right? SIP is a different game, but in stocks, you need to build size in stocks that you have conviction. I didn't do that. So that's a big mistake, actually. The other thing is, you can never get some calls quite right. It's best to stay away from them. Like I have tried to time sugar at least 2 or 3 times. I always got it wrong, either my entry or my exit, right? Some sectors, it's so hard. Paper, sugar, it's so hard to catch them. You just leave them out. That's all, right? That's something that I learned, kind of over time. And I also learned in 2008, before that, why I should have book profits. I didn't, and I had seen a steep fall in my portfolio. The good thing is I used those falls I had the luxury of some surplus with me, and I used those falls to add, and I just simply did index investing. I bought the Nifty ETF. So the benchmark Bs had, it was early days of benchmark Bs. I was very fascinated to invest in benchmark Bs, and I would just go on adding them. That really helped. So sometimes when you don't know which stock to invest in, you simply go with the market, right, in falls. So I started doing that, all those much later. I could have done them earlier. The other thing is not clearing the bad stocks in your portfolio. I do that very diligently now, but I just allowed it to be earlier on. So cut losses. It doesn't matter. Many of us have this mindset of waiting for profits before at least get my capital back. No, it doesn't work like that. Just cut losses. At least you'll have the capital loss for you to now set off against your capital gain. So it doesn't matter. Just cut losses. So those are few of the things, Prince. I mean, I have plenty of learnings, but these are some of the primary ones.
Yeah, great, ma'am. So before coming to Binay, I have a small question. Like you started in the role of auditor. So does that experience help you as far as your research is concerned?
Yeah, I guess to some extent because it has taught a lot of skepticism. So definitely it helps as a quality. But joke apart, definitely in terms of looking at numbers more closely and sometimes, looking at the accounting changes that companies do, like changing even something simple as a depreciation could be to dress up numbers, right? So those are things that you really know when you're an auditor, because you've probably seen that happen to the companies that you audited, or you were part of them for all you know. We don't know, but it definitely does help. It looks at numbers more closely, without any doubt. And because I was doing my articleship um, in a place which gave me very rich experience of going to factories, going to the site, seeing and seeing factories and floor. That really helped me get a better understanding when I started analyzing companies, because I had seen manufacturing places. So that was a really rich experience.
Great, thanks. Yeah, Binay, now you can unmute and quickly ask your question. Binay, you are still on mute.
Hello, can you hear me?
Yes.
Uh, okay, yeah. So my question was on around allocation strategy, Vidya. So you were just mentioning that you need to put your position. So how many stocks ideally you have in your portfolio, and how much of your say top three bets would constitute what kind of percentage? Because I also believe that your top bet should have the highest, allocation.
Right. So my top three bets would definitely be about 25% of my portfolio, at 25 to 30% of my portfolio. I have a little bit of a diversified portfolio, so I still see place for consolidation. Sometimes I experiment by just putting money in some stocks, not because I want to build, but I just want to kind of observe. The only way to observe is to put your own money, right? So I do that. So my portfolio is not very compact, but 25 to 30%, yes, that's what I have, I think.
Right with them, ma'am. So I mean, like, what all offerings do we have at primeinvestor.in, and like, which way, if somebody is interested, can reap the maximum benefit by connecting with your team?
Right. So Prime Investor, like I said, has a list of researched recommendations and a rich set of analyze tools with which you can use the already analyzed data for making your own conclusions. On recommendations, we have a wide array of products. We are not just recommending mutual fund stocks, which is what pretty much what most people do. We have mutual funds, we have stocks, we have recommended ETFs, we have deposit recommendations. That's interesting and you should check it out. We have even an FD tool which will tell you our confidence in the bank that you want to invest in. I mean, you want to choose the deposit in. And then we have, term insurance, health insurance, because we think these are the two essential products that any investor needs. And then we also have an NPS ranking system where it will actually tell you what asset allocation you should have in NPS and how much to build. We recommend privately placed bonds selectively where the risk reward is fine. It is meant for those with higher corpus. And then we are probably the only folks around, who actually give recommendations to retail investors on government bonds and government state development loans. So those are, broadly the products that we recommend. And then we have ready-made. So we have something called ready-made portfolios, where if you don't want to be picking and building your own portfolio, we have packaged portfolios that you can invest for specific time frame, specific requirement. We have about 19 unique portfolios to choose from. If you have an income need or you're a retiree, you can go. It's a mix of products. It mixes deposits as well as mutual funds to kind of align with your overall goal. And then there's also a portfolio builder tool that we have. You can actually give your requirement and we will guide you into building a portfolio. Make sure that you're not taking a wrong direction, but at the same time, allowing you to add more funds if you want from our recommended list, or reduce it, or change the fund if you please, and things like that. So these are things tools that we give you so that you feel empowered. At the same time, you are still guided, right? And there are plenty of other tools. We have stock recommendations, obviously. Then we have a stock screener. It's one of the most unique screeners where we screen stocks. We help you screen stocks based on valuation metrics, based on growth metrics, based on the balance sheet, that is a quality metrics. Then we have a stock ranking tool, which again ranks stocks on these three parameters. If a stock ranks high on all three, you know that it's up there. At least you will be able to filter your stocks. At least we would have done the groundwork for you. Of course, if you don't want all the pain, we still have prime stocks. That's a recommended list. Apart from these, we have 3 small cases. Now, that's available on small case. We have an auto, we have a finance squared portfolio, and we have an ETF portfolio. That's separately on the small case platform. Our product offerings are just 2 simple plans. One is Essentials, where you get all of much of what I said, other than a little more of the advanced ones, which is bonds and stocks, and some of the advanced tools are available under what is called the growth plan. So Essentials at 2999 and growth per year, and growth at 5999 per year is our product offering. It's flat. So we are not going to take a percentage of your AUM simply because we are not managing your money. We give recommendations, we review them, we come up with alerts, we come up with strategies when the market warrants it. But we just say, hey, go and invest on your own. There are plenty of platforms out there now available for you to invest. And those are not great platforms to take advice from, but there are great platforms to invest in, where transaction is made very easy. So we are not going to do the job of selling any product for you. We're going to recommend, and you can use the direct route, whether it's insurance or mutual funds, and save on costs. So that's the proposition, and that's our offering.
Thank you for explaining with great clarity. Yeah, you had something. Yeah, you can quickly
no,
ask.
just a follow up one on that, Vidya, is, see, there are so many similar kind of advisors. So I just was curious, what is your differentiator? I mean, the people who follow same models of, we'll help you with a recommendation, just with this fee, and these model portfolio from mutual funds and this that. So what is your differentiator? I mean, like you said, screener. So there is a screener website. There's a trend line website, which allows all these screeners also with all the P&L, balance sheet, cash flows, all there. So I mean, what's your real differentiator?
Yeah. 80-90% of platforms out there are information and data providers. Okay, they are not providers of recommendations, nor do they follow up on the recommendations. And the other 20% that we are talking of, two things. One, they provide packaged portfolios. That's all. They give you model portfolios. They charge a fee. They ask you to invest in that model portfolio, and they'll review them. Right. The other set are giving you individual stock recommendations. Hey, we'll give you 5 stocks a month, 10 stocks a month. We do none of these. Okay. We provide recommendations in a way that we also have portfolios, packaged portfolios that you can use, which we will review. We don't sell them alone. For this entire 2999, you get recommended funds. You can choose portfolios that you want, or you can build your own portfolio. You get recommended ETFs, you get recommended deposits, bonds. You get at least once a time you will use your term insurance and health insurance. And we have, very importantly, an MF review tool where we have buy, hold, sell recommendations that you can review your funds. You can simply put your funds, what our recommendation is. If we have sell, you can just dispose of the fund if you trust, that we are doing the right job for you, and compact your portfolio. So we have every offering that is available separately in many of these places are available in one place for the price that we are talking of, right? Like I said, it's only this 15-20% who even offer, but mostly they offer either stock recommendations separately or they offer package portfolios. Ours is just one of the offerings that we have, and nobody, I can tell you with confidence, other than media, and media is not regulated by SEBI, please remember, and they don't take onus for what they give. Nobody other than media comes up with a wide range of recommendations that we offer. And very importantly, I must tell you, we are not people who just, we are a startup, but we have really rich experience. People like me, Bhavana, Aarti Krishnan, you would have heard about Aarti Krishnan also, is a renowned journalist, and Srikanth Meenakshi with, in the last 20 years of fintech background here itself. We come with very rich experience in terms of dealing with thousands and thousands of investors. And our earlier experience, when we left, FundsIndia, we had dealt with about 6,000 crore of AUM of customers and individual investors, retail investors that we're talking of. So the product that we have built in Prime Investor, starting from, so you can just register for free, you will immediately understand what is the differentiating factor that I'm talking of. These are not just something that you just give and say, hey, I'll come up with changes as and when it happens. No, we come up with articles every single week. Every single week, at least 2 to 3 articles that will explain to you strategies, that will explain to you concepts, and give you alerts when things need to change. For example, we were well ahead of the market in terms of giving exit calls or reducing exposure to Franklin funds. We had warned investor as early as the November, when the actual fallout happened in March. So that is the kind of active approach that we take in terms of also alerting you. So it's not a package that you buy, it's not a model portfolio that you buy, it's not a stock tip that you buy. You buy an investing experience, and you basically buy the story of empowering yourself with Prime Investor. Please just do a free trial and you'll understand what I'm saying.
Yeah, right. So Vidya, like we had a very interesting discussion so far, and like so much of learning and learning from your experience. So any good books or literature you would suggest to our attendees, which can be beneficial so as to make them smart DIY investors?
Right. If you're a beginner to, investing in markets, I definitely believe in the old school. I would say begin with The Intelligent Investor by Benjamin Graham. Although I know many of you, if you're young, would be enamored by the YouTube videos and the plethora of information out there, I would still suggest read a good old book, and you will be better off for that. The second thing, if you're already into investing, you're making your own decisions, etc., I would strongly recommend that you read The Psychology of Money by Morgan Housel. It would change your perspective about dealing with money. So these are 2 things that I would highly recommend.
Great. So many thanks for this, and first of all, like thank you for agreeing to come today and sharing your thoughts with us. And surely, like we will also have one similar session with the Aarti ma'am also. So Vidya, any closing remarks before we close the session, and like if you have any view on the spaces I conduct? Yeah.
Yeah. Prince, I have been, in recent times noticing your, Twitter comments as well as your YouTube video and, this Spaces recording. Congratulations. I think what you're doing is very responsible kind of work. We have, of course, we do know in this age that many of the quick suggestions, quick tips, or the influencing that happens can make or break people's financial lives. In the midst of that, Prince, I think you're doing very kind of a responsible work, and more power to you on this. And I think, many of you who have not, you possibly should try and follow Prince in The Accidental Investor, because he has a very fine set of people that he invites, very serious, folks, and, gets them to share their experiences with you. So I would encourage you to follow that. My final closing remarks, nothing. I think the entire sometimes the problems to very, I mean, the solution to very complex problems can be very simple, right? So do not try to um, be bogged down by the complexity in the markets, in the economy, in the geopolitical tension, and all of those. Yes, though they do have a bearing, but the good thing is they all have a very small bearing. So it's just the collective thing that finally comes in terms of your fund returns or your stock returns. The best you can do is, follow a disciplined process, have less emotions, don't try to love any fund or stock, have less emotions, and try to take corrective actions. That's more important than trying to get calls right. I have learned over time that it is the corrective actions or sometimes staying away from risks, containing risks. It's one of our philosophies at Prime Investor that we build your wealth by first reducing the risk, by reducing the downside for you. So I think follow that philosophy, and I think everything else will fall in place. And all the best to all the listeners here. And I thank you so much for spending late evening hearing this. Do try out our product, the primeinvestor.in. Go for a free trial and feel free to write to us. You have a contact us box there. Feel free to write to us to know more. And happy investing.
Thank you so much for your kind words, ma'am. And there is one handle by the name of Investment Books, one that is run by Dhaval. So I got the recommendation of your team from him, and the work you guys are doing is fabulous. And my best wishes to the whole team. Keep adding value to the community, and it is indeed great to have you today. And surely look forward to many more interactive sessions down the line. Thank you so much.
Thank you. Thanks.
So guys, you must have enjoyed the informative session. So you surely should check out the handle of Vidya ma'am and the